Okay, there we go. All right. Welcome to the Money Made Simple Investing Fundamentals webinar. Thank you for joining. And for those who couldn't make it, this is the recording. So feel free to message me with any other questions that you have that might not be answered through this presentation. The purpose of tonight is to not go through hot stock tips or what to invest in and where and when, etc. It's more to understand the concept of investing and what it means for you and what you then will do from here. So quite often we launch right in, feet first, and haven't necessarily thought about the specifics of why we want to invest, and then we start to look at the what and then the how. And because there's so much information out there, and I'm aware that there's information overload as a result, and this is to try and take a step back, chunk it down, and ask some fundamental questions before launching into the investing journey or continuing along the journey. Keeping in mind also that in terms of being an investor, if you've got superannuation, which most of us do, you're already an investor. But then there's also investing outside of super to really help to wealth create, because that it's really the only way we're ever going to get to where we need to go, because there are limitations on how much can go into super from a tax perspective. That doesn't mean you can't go beyond that. You just don't get the tax benefit. Just a brief introduction to me, for those who don't know me. I'm Alpha. Yes, that is actually my real name. It's on my birth certificate. And because I see a lot of things in relation to money these days that are Alpha, and I'm like, oh no, this is genuine. It's actually my name. My background originally is accounting. I was working in corporate tax for one of the big, they were big five in my day. They're big four accounting firms now. I started as a graduate, worked in that industry for a number of years, both on the consulting side and on a company side. Realized that it wasn't necessarily for me, so I moved in a different direction and went into consulting more broadly. But the finance side always just sort of stayed there. And what triggered this particular personal finance journey was I had a financial planner myself, and after probably about a year, I was getting I wasn't very happy with the direction it was going, and the results that were going, and whenever I asked questions, they weren't really getting answered. So I like learning, so I actually did the diploma of financial planning, and then engaged, discussed with other financial planners, and I realized what was happening was not the way it really should be. And so I fired the financial planner and took everything over myself. And then little by little started helping friends, and then it sort of made me realize how much information is lacking out there just in how to manage money. What is money? What do we want with money in our lives? And also that fundamental concept of what do we value? What are our values, and how does that influence our lives? We don't get taught any of this anywhere. And if we're lucky enough to sort of have parents who help us along that path, that's fantastic. Otherwise, we have to sort of learn through trial and error. And I'm trying to help people fast track that, because this has been about a 10-year journey for myself. Hi, Elizabeth. So we've kicked off. I'm just giving a bit of a background for myself, and then we'll keep going. I am recording it though, so you can always go back and watch the beginning if you'd like. So yeah, so this 10-year journey of me sort of doing the study and getting some experience and sort of fumbling around and making mistakes, and then realizing what was working for me, and had helped friends and friends of friends do that as well. And I thought I want to be able to do this for more people, because I think it's terrible that we don't get taught any of this. There's no money education out there, and we just kind of, with the amount of money I've wasted in the investing space as well, just blindly kind of falling around the place. So the purpose of tonight is to focus on the investing side specifically, nothing broader than that. Primarily because a lot of people, the first thing they say is, I want to build wealth. I'm like, okay, that's great. Let's go back a step and ask some fundamental questions. So here is what we will go through in tonight's talk. So before I start anything, the first question I usually ask is why. For those of you familiar with Simon Sinek, you'll know he starts with why, and I like to do the same. So why do you want to invest? And when I say what gain do you want out of it, of course, we invest because we want to have some sort of financial gain. But it's more than just the financial side. Like, do we want to have, like, some people discover that they have a real passion for day trading, and the gain they get is the excitement and the hunt and the chase and all of that. To be honest, nothing would, I would absolutely hate that kind of thing. Doesn't, like, even the concept of the auctions on eBay, I'm like, I don't really like the whole auction, raising of blood pressure, etc. thing. I just want to get what I want and then move on. So, but that's me. So this is why it's important to understand what sort of investor you are, why you want to invest. Do you want to invest for security? Do you want to invest because you want to increase your return to save for something? Is it short term, long term? So things like that, and the questions we'll go into a little bit more. And so the second point is, how do you figure out your risk profile? So this also is quite important to figure out. And for those of you, some of you probably are familiar with the concept of a risk profile, and there are formal profile questionnaires that you can do online. Some are free, some are paid, but there are still some fundamental questions you can ask yourself without having to necessarily go down a formal path. Thirdly, what is a diversified portfolio? I subscribe to a number of different financial things, and one of the things I see a lot is property. That there's a huge, and also there's crypto. There's certain trends that kind of come and go, and waves of what's kind of fashionable, I suppose, when it comes to investing. But ultimately, we want to have a diversified portfolio to protect our financial assets, depending on what's going to happen around the world at any given moment. As we've seen over the last 2 years, lots of volatility, lots of things that haven't followed a traditional pattern, things that can't really be predicted as well. So the one thing that's there that can help protect you is having a diversified portfolio. So we'll go into that a bit more as well. Number 4 is, what is your asset allocation? And I realize this, I'm going to try and limit the jargon as much as possible, but I also use it too, because if down the track you do actually engage a financial planner, they're going to use this sort of language, and I don't want anyone else to be as uninformed as I was going into it, where somebody spouts all of this jargon and you're just there going, oh wow, this is really complicated. I really have to pay you whatever you're asking to do this for me. I'd like to empower people to understand more about what they're being told, so they understand the terminology, the key terminology. So asset allocation, we'll talk about the types of assets. This also links back to your diversified portfolio. So I'll go through that in a little bit of detail, not too much jargon. And then finally, micro investing. A lot of clients come to me and they're like, I just don't have the money to invest. I put stuff into super. Some people may even salary sacrifice additional amounts into super, and they invest as part of their superannuation. But they're like, I don't have anything else left. But, well, there are alternatives to get you started, because one of the biggest things with anything in life is consistency and momentum. So if you consistently, even just a few dollars, and I'll go into this more, because I have an experiment that I started about 5 years ago to actually demonstrate this, what you can actually do, and if you're consistent with it, you'll start to see benefits. So I'll progress into the first one, and why. So again, why often comes down to our values. I'm a big believer, if you've seen anything that I post on social media, I talk about values quite a lot. And they link back to the type of lifestyle that you want and the things that you value in your life that reflect back on your lifestyle. And this also comes back to being your authentic self, and also looking a bit more inward to understand what it is that you want for you, for your family, and what you want for your children, and how to help guide them to understand what lifestyle that they want, because they might want a completely different lifestyle. I'm relatively, I don't need fame and fortune and glamour and all that kind of thing. I prefer to be a bit more earthy. But my daughter, she might like to, I don't know, be a rock star. At the moment, she's got her drumsticks going and she's beating on the pots and pans. But, you know, not right now, she sleeps, but during the day. But she could want to go down that path. And I feel like it's up to me to help her understand what she values in life. And if it's different to us, then that's okay. So I've got a couple of values on the screen here, and there's an exercise that I actually do with my clients. And I also offer a free values discovery session. So if you'd like to go down that path, let me know and we can set something up. And there's cards, or we can do it online as well. There's another way to do it electronically too. And things like achievement, fulfillment, things that when that word comes to you, what do you feel inside? My top value is creativity. So I like to create things. So not necessarily just, you know, buy something and do it. So packet cakes, not my thing at all. I'll get a recipe, but I'll never follow it. I go, okay, I'll adapt it. I'll do this. I'll tweak this here and there. I like to have my own little touches. So I'm not very good at it necessarily. I can follow instructions if I really put my mind to it, but I like to be able to experiment and create and adapt and try things and try and improve it from my perspective, of course. So, and then you have things like honesty, wisdom, independence. There's so many values out there, and there's ways to delve into them as well, because there's things that on the level of our lives that we think are important. But when you start to ask, why is it important? You're like, well, actually, it's not this, it's that. And that's where the sweet spot really happens. So that's where I'm like, why do you want to invest? What do you want to get out of it? What part of your lifestyle do you want to improve? Are you investing for now? Are you investing for the future? Do you want to go on holidays? How much wealth do you need in order to support the lifestyle that you want? So these are all fundamental questions to answer. Well, I will be taking questions at the end, so just take some notes if you need to as I go, and then you can ask this time for Q&A at the end. So the next thing is about your risk profile, and so this is also there's some formal parts to this, but then there's also humans are emotional creatures. We don't always make decisions rationally. There's a lot of emotion driven by that, and risk is very emotional. So the first question there is, how do you feel when an investment fluctuates? If you're checking them on a daily basis, you're probably going to, at some point, feel a little bit of heart palpitations, because things will go up, things will go down. I look at things just purely because I like to know what's going on. And when I see things going down and it's red, rather than going, oh my gosh, I'm losing all this money, I'm like, oh, I'm going to start buying a bit more, I think. So, and I've had to train myself to be a bit more like that as well. So it takes some experience and some time to get to know yourself and help to adjust your perspective on things as well. But investment fluctuations, and it's not just a matter of, the stock price has changed $5, $3. This is more like a 20% drop. And going up the other way, so a 20% gain, to be honest, most of us just look at that and go, oh yeah, that's nice. But when the drop happens, that's when our stomachs literally drop. We'll have more of an emotional reaction to a loss than we will to a gain. Human nature. So then the other thing too is, how much time do we want to invest for? And this comes back to the lifestyle and what we're investing for as well. And also our age. How long do we have still to invest? My husband is 10 years older than me. So when he looks at his superannuation, his investments, he's making very different decisions based on the longevity of an investment to what I do, because I've got 10 extra years. If I look at, if we look at mortality rates of men and women, women live a bit longer, not too much, but we do, and it's towards the mid 80s. So there's still a lot of time there, but not as much time as I've got, potentially, hopefully. So you've got to actually consider that too. Most investments, when you look at them, will say minimum 7 years. Some will be more like 10. So if you're investing and you're expecting a return just like that, it's not realistic. If you want to look at day trading, then you might have a different perspective on things. But then that's a whole different ballgame. You're going to sort of have weird sleep patterns if you want to do day trading. So time is a very important factor in all of this as well. Liquidity, that's another term, but how liquid do you want your investments to be? Property, well, ordinarily, property is not hugely liquid. At the moment, the market is quite liquid, really. People put a house on the market and it can sell within a week. However, the cash itself, you probably won't see for a few months. So it's still somewhat illiquid in that way. So you're not going to be able to convert an asset into cash, which is what makes it liquid terribly quickly. A share, you can sell it and money can be in your account the next day, depending on whether you've got public holidays or a weekend. So it's a lot more liquid. Also depends on, excuse me, the investment itself as well as to what the demand is. So some, and this is quite rare, but some shares nobody wants really. So, well, not as regularly. So you might not have as much ease selling those. A similar thing with property. If you're in a more remote rural area, it's a lot harder to sell that property than it probably would be in an inner city apartment. Or you could have too many inner city apartments that are flooding the market and it's difficult to sell. So it really, really depends. But if you consider the liquidity when you're looking at your risk profile. The other aspect is the costs of buying and selling. This is something that quite rarely gets factored in when I talk to clients, like, oh, I bought this house for that and I sold it for that, or I bought this share for this and I sold it for that. And more so with the property, I was like, okay, well, what were the costs that you incurred while you held the asset? What were the costs you incurred to buy and sell? Those all need to be factored into this as well. And obviously the higher the risk, quite often, the higher the cost too. So you need to consider that when you're actually looking at your risk profile and what you're prepared to invest in. And it's not just the like agent's costs, for example, it's stamp duty. Then you've also got interest rate. There's all sorts of costs that go with property. And then if you are going to borrow to buy shares, then there's costs involved in that as well. So that needs to be factored in when you're considering what your risk profile is. Tax. I did say I'm an ex-tax accountant, so pretty much everything I do comes with a bit of a tax hat attached to it. Capital gains tax in particular here. So your own home, obviously that's off to the side. So we're just talking about investments here. Capital gains tax can really slug you. My dad, a couple of years ago, his relationship broke down and he had to sell some property. He had quite a substantial capital gain. There were some losses that we could apply as well, so that sort of helped him out too. But capital gains tax is still going to be quite an issue. I'm not a big fan of paying tax. If I don't, I don't try and avoid it too heavily, but you've got to look at that as well and try and make your decisions before you buy. You have to have an exit strategy before you buy, and that's all part of the risk profile as well. So it's I'm not trying to scare anyone, but there are complexities to consider, and there's often these sorts of things get sorted out after the fact. And I had quite a few high net worth individuals when I was working for the big consulting firm, and they rarely thought about this thing up front, and then they were always shocked by what the costs were, the tax costs were afterwards. So I would highly recommend thinking about that sort of thing up front. So that's risk profile. Again, this is all just high level fundamentals to think about, just to get the thought process going. And there's lots of it's a lot deeper to go into a lot of this as well. But in half an hour, I'm just going to cover off on the basics. So a diversified portfolio. So this is, again, what I said will help sustain people through highs and lows, ups and downs, in terms of spreading out their risk and also spreading out the returns that they can get from different investments. It's often talked about as being defensive or growth, and this will come into the next topic I talk about with asset allocation as well. So defensive things are ones that will help defend your portfolio, typically lower returns. So things like cash are defensive, term deposits, which are basically cash, fixed interest. There's a number of different things in that category, which again I can go into in a bit more detail. But they're things that will help defend, as the word. Grow obviously comes with a lot more risk. So things like shares, managed funds, depending on what's in the managed fund, even property to a certain extent as well. So you look at being in each sort of category, so to speak. Then there's things like crypto, which is a whole different thing. I have a personal opinion on crypto, and it's at the moment I think it's still a bit too volatile. So I'm not sure I'd even categorize it in the growth space. But you could also include things like gold, although some people would consider it defensive as well. So, but again, the key here is not having all your eggs in one basket as having them spread across. And one of the things we're all quite heavy on in Australia in particular is property, because it's what's drummed into us. We understand it. It's bricks and mortar, it's physical, but there's different ways to own property as well. There are new schemes now where you can own a brick in a property. There's property investment funds. You don't have to actually own physical property. Commercial property makes a lot more than residential property. It's also a lot more expensive to get into. So you can buy into property trusts, as an example. But yes, the risk gets balanced over the portfolio, and diversification is the way to balance that risk. And like there's often an inverse relationship. So risk versus return, it's a similar kind of concept where you have defensive assets and then you've got your growth assets. One will be doing better than the other at any given time. To be honest, at the moment, it's interesting to watch. Whenever I see the share market go down, I then start to follow gold to see what it's doing. Ordinarily, they're inverse. You see gold start to go up when shares go down. Lately, it hasn't quite worked that way, not to the extent that it used to. So again, it's interesting times, and they're things just to watch and be aware of. Who knows, the investing landscape may be changing. And if that's the case, diversification is probably an even more important aspect of investing, to make sure that you've got eggs everywhere. So that's diversification. Now, asset allocation. So I've got a couple of options here. And again, this will depend on age. So like I said, my husband's asset allocation is a bit different to mine because there's 10 years difference there. And this is your ratio between your defensive assets and your growth. So I've got a couple of scenarios listed below, and risk profile does come into it as well. So if we look at, for instance, and I'll go right to left here. So if somebody's 35 years old, they might be, they've got more time to invest, to be able to ride out ups and downs in the market and the cycles. Typically, cycles have been historically about 7 years. Again, that's changing, but there's still the time aspect to it. So someone who's a bit younger, and also depending on the risk profile, this is a relatively conservative 35-year-old, might go more like 40% defensive, 60% growth. You could go 30-70, 20-80. It really depends on what as an individual is comfortable with, but it demonstrates the time factor that's all in there as well. And it's a lot more high risk investments that are possible to go into because you've got time to ride them out. If they plummet and they're going to take about 10 years to get back up again, you've got time to do that. Whereas somebody who's in their mid-70s doesn't have that time. So then you go to more medium risk when you're kind of in your mid-40s, again, depending on your own personal risk profile. And by the time you get to sort of you're well into retirement, you might start to go, oh, okay, no, I don't think I'm comfortable holding quite so many shares anymore. I might sell those and put them into I'm going to use this somewhat sarcastically, high interest bearing bank account. There's not a huge amount of that going on at the moment because money is quite cheap, and that also means it's cheap to borrow. You also don't get much on the return side from, say, a term deposit. A few years ago, you were able to get to like 2.7%. Now it's almost negligible. So it's unfortunate, but nevertheless, for somebody who's in their mid-70s, it's better than losing it if there's a share market crash. So it's balancing that needs and creating that protection over the portfolio and managing the diversification through your asset allocation. So hopefully I'm not using too much jargon here and you're following me, but like I said, if you need to, write some notes and ask some questions shortly. And we can also have a conversation after this as well if you wanted to ask some more specific questions and don't feel comfortable doing it on the call. So then I'll head on to the micro investing because I'm conscious of time. So this is where you can literally micro. It's exactly what it says, micro investing. And the experiment that I was talking about earlier, the one I started with, it was called Acorns at the time I started, and it's since rebranded itself and called itself Raiz, R-A-I-Z, which I find quite. I thought Acorns was a really good name. Anyway, when they started, and you can invest your small change. So you connect up your bank accounts, any credit cards that you've got, and anytime you make a purchase, it rounds it up, and then it takes that round up and puts it aside. And then once it gets to a certain amount, I think it's $5, it actually invests it. So I just do roundups. You can invest extra. You can even use super as well. I don't do anything fancy like that. I've just done roundups from day one, and in 5 years, I'm up to, I think, about $4,300. That's money that's just kind of been there, and I haven't done anything to notice it, and it's now $4,300. I was quite amazed at how quickly it grew. But that's what I mean by consistency builds momentum, and momentum just kind of compounds like a juggernaut. So you then benefit from that compounding. So micro investing, and like I said, you can top it up. There are now a whole lot of other platforms that do this as well, because it's become quite popular. To be honest, I'd like to see this sort of thing done more than like you buy now, pay later kind of concepts, because that's just money going the other way. Anyway, that's a topic for another day. But yeah, so you make small, irregular investments just with day-to-day transactions, and you can start with $1. When you look at sort of some of your other investing options like ETFs or shares, obviously you have to buy at least one share, and they could be hundreds of dollars. Managed funds, your entry price or entry amount is usually $5,000 minimum. So starting with $1 is pretty good, and it's also a great way to get kids involved in investing as well, because it's a lot more sort of tangible for them. Obviously, it's done on a phone, so it's not cash. I'm teaching my daughter with cash, which is often challenging because some places these days don't accept cash. But nevertheless, they can, once they're old enough and they can see it on an app. There's even funky names like Spaceship and Sharesies and Bamboo, and there's lots of different options out there. I've just chosen Raise because I like its roundup function, and a lot of the others don't do that. But they still allow you to micro invest, and some of them will also now include ethical investing in that too. So you can actually choose the type of investments that you want to be in. Sustainable or ethical investments as well, which is becoming a more and more focus. It's getting a lot more focus in the investing world, which is great. So that's micro investing, and so anyone who says to me, "Oh, I don't have enough money to invest, I can't invest. I can barely buy myself a coffee every week." But, well, you could maybe do a coffee every second week. And put some money into this, and just set it up so that it just does roundups even, so you don't even notice it. And you can set it up for your kids so that it's done for them. There's also ways to invest for children, which I haven't covered off in here. I have covered off in previous videos. But if you're interested in that, I can direct you to where that is, because, anyway, investing for children is another topic, and it's one I'm also quite passionate about, so I won't go off on a tangent. But that's basically investing fundamentals. I do realize there was a lot in there. So I'll just quickly go through this, and then I'll open it up for Q&A. If you do want to know anything more, I've got the Money Made Simple plan that I'm launching from the 1st of April. It includes the online course that I've written, which starts with income and works its way all the way through to investing. There's even a separate online lesson on investing for children. It's there to help cut through the overwhelm and help give people the fundamentals and the confidence that they need to be able to make their own choices, and empower them to be able to take charge of their own finances for whichever outcome they need. I know I've had swings with clients. I've had one, it's helped her gain the confidence to leave her husband and go down that path. And I've had another client who actually gave her more confidence to stay with her husband, because she felt that now she was financially empowered. So I've had the gambit on both sides, which was it's quite sort of quite humbling to be part of that, to be honest, because I'm involved in people's lives, and it's the trust that's instilled is very special to me. Anyway, so yes, there's a couple of things going on there. Then there's one-on-one coaching, which I have as part of a plan too. And in the Money Made Simple plan, there's one-on-one time with me. There's some group coaching as well, and a Facebook group page where you can always ask questions and lean on one another. So I'll leave it there, and any questions that anybody has, feel free to ask me now. Fine. I'm not going to unmute anybody unless you want to be unmuted, so I'll let you do that yourself.
Thank you, Alpha. No questions from me. The raise concept sounds very interesting.
Yes, yeah, I definitely recommend having a look at that. It's nice and easy. And like I said, for me, it's set and forget, which is quite often how I like money and investing to be. It needs to be simple, which is why I called all this Money Made Simple. Elizabeth, if you're not comfortable asking questions on the video, feel free to message me privately, and yeah, and we can. And if you don't have my details, you can always go onto my website and hit the contact us button and send me an email that way. But if there's no other questions, I might leave it there then. And thank you very much for joining. And I hope you got some valuable information out of that this evening. And yeah, feel free to ask me other questions if you'd like to.
I'd just like to make a comment. Can you hear me?
Yes, I can.
I would just like to make a comment as to how easy it was to understand all of that. I'm not in the generation that really knows that had any knowledge of all this sort of stuff, you know. And from listening to your various webinars, and apart from the fact that you're my daughter, and I can ask you questions anytime, but I found tonight's presentation on a subject that is really complex, just so clear. And I just want to say thank you.
Thank you. That's good. I'm glad, because that's what I aim for, because it's, yeah, got lots of jargon, which can be pretty easy to overwhelm people with that, and that's what I want to try and avoid.
Yeah, no, it was fabulous. Thank you.
Thank you. Okay. All right. Well, I'll leave it there. And again, thank you very much for joining, and have a lovely evening.